Hey guys, it's Jim Black here from All Cal Financial. It's Thursday, 4/9, April 9th, about 2 o'clock. So this is relevant economic information as of today. So we know things have changed every day. We know there's all kinds of updates happening in real time. So I am so thankful to have our guest here today, Kristina Kuprina, who is the owner and founder of Sequoia Wealth Advisors, a wealth advisor company who also does certified financial planning, strategic planning, and helps a lot of local charities even with their financing strategies. So Kristina and I have become dear friends over the past few years, and we have a long-standing history of a similar background with both being traders on Wall Street back in the late 90s and early 2000s. So Kristina, thank you so much for being here. We appreciate your time.
Okay, thank you, Jim.
Awesome. And our goal today is to basically have it be a setup where we're going to have three questions we ask Kristina about what's happened in the past 3 weeks, what she sees happening in the near future, and then also ways that we can have Kristina help with our clients, with our own situations, and make sure we get her understanding about how we can reach out to her. So Kristina, thank you again for your time. I know it's a wild day on Wall Street. We've seen very large swings in volatility. We've seen news have direct and impact effects in all elements of financial markets. And I would love to first ask you if you could kind of recapture or summarize what you've seen in the past 3 weeks in this extraordinary time.
Absolutely. And I'll start with, I won't talk too much about what has happened because we all already know what has happened. I'll touch upon it briefly because it'll kind of put the foundation for what's likely to happen next.
Cool.
My caveat is exactly yours. This is a rapidly changing situation. And what we know today could be very different tomorrow. But we can use probabilities. And I'm an economist by training and an analyst by profession. So you can use a lot of data to project what's likely to happen. And you can also balance out the what ifs as well to get to the highest probability outcome. So I'm glad to hear that you're doing these regularly because I do a webinar at least every 2 weeks to my clients, as well as regularly to other groups. I was just talking to Jim. I did one to small business owners this week. I did one to Silicon Valley executives this week. I've done actually one to charitable organizations as well as individuals. So there's a lot of this because everybody will use this information differently. So I'll talk just a bit about the economy and kind of where we're at and why, and what's likely to happen for the rest of the year. I'll touch upon a bit how I see it may affect the real estate market and the lending market from an economist viewpoint. You all of your audience knows a lot more about this subject than me, and the last thing I want to do is, as they say, go outside my lane. So I'll touch upon it, as I say, as an economist, but I won't go too far into it. However, I will answer questions to the best of my ability as people pop up on your chat. So we had those shock event, the coronavirus. Obviously, we all know about that now. And it isn't so much the deadliness of it, because we've had far more deadly outbreaks in the past. It's the contagion level, the fact that it spreads widely and quickly. And just as a reference point, they're now coming up with, I have a lot of access to a lot of information from really smart people, and it helps me do my job. And I will say what I'm getting from the healthcare and medical professionals that I'm speaking to that are very, very knowledgeable in this space is the expectation is everyone is going to catch this at some point or another. The other thing that's being basically at this point somewhat coming to be known is that many of us already have. We just don't know it. And I'll give you the background for this because this fits very importantly for what I'm about to talk about next. So this began in China in late November. China officially announced it when they figured out what was going on, and we can all argue about the accuracy of their data, of course.
Right.
Officially announced it in the beginning of January. Since the beginning of January, since the time they announced it, to about a week ago or a few days back, there have been over 438,000 individuals that have flown from China to the United States. Now, these are direct flights. It doesn't account for people flying from China and stopping in Hong Kong or somewhere else.
Mm-hmm.
They're Chinese nationals coming here, as well as foreigners and U.S. people that do business over there, travel, etc. So there's been a lot of exposure for a long time. We can just automatically assume that a big portion of that also happened in November and December when nobody had an idea what's going on. There was a pretty significant flu season this year in December and January. Many people got sick, and it wasn't the flu. Most people recovered. And I saw that personally myself I've never had this many sick clients come to see me in a short period of time. And so now they're theorizing and they're trying to analyze how many people have caught it. What's the rate of people that potentially could be now immune to it, at least for a period of time, as well as not able to spread it. So this is why what's more important than the new cases is the number of people who have antibodies. So the antibody testing that's coming out. I'm bringing this up not because I'm a coronavirus expert, because again, this sets the framework for the economy going forward. These tests are rapidly being produced. Stanford University actually did testing in Silicon Valley on Friday and Saturday of last week, starting to see is what they think actually true. Because many of the flights from China do come to the cities and the areas that are most impacted, it's a great place to start as opposed to more isolated parts of the country. So with this being said, this is why the outcome is a little uncertain, because the idea of restarting the economy, but also protecting human life is the balance that's trying to be determined here, right? There's one side that says one human life is not worth restarting the economy. The other side says we have to get the economy going because of the suffering of the loss of income and the financial devastation could be far greater to far more people, okay? And this is the weighing scale that's trying to be figured out. And I'm going to use a quick example of this, cars. Now, we all know that somewhere between the year 30 to 50,000 people a year die in car accidents. Over 100,000 are injured, many of them permanently. Yet few people are afraid of getting behind the wheel of a car, even with those probabilities and odds. And we try to mitigate the risk by having people properly trained and licensed, penalizing people for driving drunk or getting it, speeding or doing any reckless behavior, and also making cars bigger and stronger and safer technologically or structurally. Mm-hmm. And this is how we mitigate and try to balance out the risk of driving for our population. So using that as a framework and example, this is what's trying to be done on a much wider scale with a much more unknown situation. So now we're seeing two things. I'm going to leave out the rest of the coronavirus stuff because again, it's widespread information, and talk a bit about what's going on in Washington for my contacts there. There's a lot going on in Washington that doesn't get in the news. We are in a very hyper-partisan environment, in which case people don't want to talk about the fact they're actually talking to each other and working together, because it doesn't play well to the constituents and in the media, but they are working together. They are working together to try to find out how can we somewhat reasonably safely restart the economy. How do we do this and how we go about it? And the doctors and the scientists and the politicians and the economists and the Fed and everybody is in this conversation, and they are having serious talks. We don't know yet how this will happen, but these things go on a bell curve. There's a spike and they go back, drop back down. So figuring out how to do that is the next important step. At this point, just putting reference into the economy, and I'm using the market as an example here, even with everything that happened to the market last month, we are still above the numbers we were in the beginning of 2019 in both the S&P and NASDAQ, right? It was sudden, it was shocking. We had no idea how bad this was going to get. The stock market, the bond market, everything kind of fell apart. And in late March, it got so bad that even the credit market seized up, which hadn't happened since the financial crisis. But this time we were smarter. When I say we, the Fed. The Fed is nonpartisan, and the Fed doesn't have to answer to anybody. They dropped in with a $4 trillion rescue program, which backstopped. And Jim, this will be really familiar to you. A lot of mortgage debt, a lot of corporate debt, a lot of commercial paper, even US treasuries. They actually had to stop in. When you know things are bad, when the market's in free fall and treasuries are in a free fall. That's how spooky things got.
And but the bond got down to what, 3.7 at one point or 3.1?
Well, the 10-year went almost 50 basis points.
Yeah.
That's just unheard of in this environment, in any environment, right? So the Fed, the extraordinary measures, and much of this is not being seen yet because it's kind of behind. But I'm sure, again, Jim, you're seeing it in your markets, right? It's really affecting as you see mortgage rates start to drop from the spike they had during this time. And so that is extraordinarily important. I cannot stress the importance of this, of everything that's been done to date. That is the most important thing because it prevented the system from failing due to the fact that not the coronavirus, but the US government was shutting the economy down. And our economy shut down. Think about like a muscle, right? You can't just stop using the muscle and think when you go back to the gym, it's going to be just as strong as it was, a month or two ago when you were there. It atrophies. It atrophies. It atrophies by permanent loss of business, permanent loss of job. It atrophies when the supply chain no longer works, when businesses can't complete projects because one piece of the supply chain is shut down, everything stops. It's really, really significant. So what the Fed was doing was making sure the cash would be there, the money would be there to even flow, but also the debt would be backstopped. Now, not all debt will go bad, companies will fail. This is not a panacea for everything. In addition, everybody knows about the stimulus plan. The stimulus plan is, it's hard to wrap my mind as an economist around $2.2 trillion and also the massive stimulus. The major reason the unemployment numbers weren't worse today is because of the payroll protection, because of companies saying, oh, we got to keep my people, we're going to get this money. That really makes a big difference in a lot of people's lives. Even if they're sitting at home and not working, they're being paid for a while to get us through it. But I want to use the muscle atrophy thing because I assure you they know this in Washington. And I sure they notice at all levels of Washington that we can't let the muscle atrophy more than what is already going to happen. Now, obviously, there's anytime you throw $2 trillion into the market, there's glitches and bumps, and there's a lot of challenges for a lot of companies getting the money they need as quickly as they need. The process was clunky. And I can imagine, Jim, if this happened to you and all of a sudden the government said, go lend all this money, do it now. Here's our application. You can't get it all together in a matter of hours.
Yeah, overwhelming. It's crazy to think about for sure.
So this types of stimulus and whatnot, more is coming. They're already working on the next stages. It will be partisan. They will horse trade. It will take time, but it is coming. But again, the Fed said today, we're going to do more. We are here, whatever it takes, and just threw a bunch of more money into the system to get the money to the businesses faster than may happen in Congress and in Washington to the political side. So I'm going to say, stop there for a moment before I get into what's next to see if you have questions for me, because I wanted to set a framework for this before I
I have two questions. You mentioned PPP and employers. So my understanding of the law that I've been studying for a few weeks or about 10 days now is as long as you keep your employees at least 75% of your current employees employed and working, there may be these stimulus packages that are forgiven. You have to keep the certain amount of employees. Obviously, if people aren't performing, then you probably have reason to let them go. But if they're crucial jobs and we're trying to save the states by not pushing them to defer to the states and take up the coffers of the state funds, is that kind of a simple way of looking at it from your perspective?
I've heard 75 or 80%. Now that's keeping the same number of employees. If someone fails to perform, someone shows up to work, intoxicated, steals from you. I mean, obviously there's reason you could still terminate for cause, but you keep your workforce even. And you have to do that in order to, if you don't do it, or if you don't comply, or you don't spend 80% of it on payroll, or sorry, 3/4 of it on payroll related expenses, you just simply have to pay it back, and the interest rates are very low. So a lot of companies have said, hey, even if we might be okay now, we don't know how long it's going to go on. We don't know. We're just going to apply for it. Worst case scenario, we just got a low interest loan with a 2-page application.
Yeah.
And a lot of companies are taking it that don't necessarily need it yet, either preparing to pay it back if they don't use it. But I would argue that many companies will be able to use it as intended, because 3/4 has to go towards payroll related expenses. The remainder can go towards rent, towards utilities, et cetera. So that's
sense. So like,
the major expense for most companies.
Yeah, absolutely. So like for real estate and lending, while lending is fantastic right now, I want to play and position myself for worst case in the future. So I've applied as an S Corp to make sure that my staff and employees are protected and taken care of. I think smart companies are doing that. And again, just to play it safe, we don't know what's going to happen in the next few months with anything in regards to disease and hopefully, or the virus, and then hopefully, dropping down and plateauing, as they say, or apexing, I should say. The other question I had was around, you talked about SBA financing and the fact that there's trillions of dollars that have been thrown in for stimulus. I've talked to probably about 100 business owners in the last 9 or 10 days. They are not getting the funds yet. They've also been told that there's a backlog of loans. Wells Fargo has cut off people from applying. They went through their $10 billion of funds that they had. And I'm hearing that some of the companies are going after their top clients and taking care of and kind of cherry picking their top clients who have maybe some debt exposure at the bank or on the balance sheet for that institution versus helping everybody. Have you heard anything in regards to those strategies that you're hearing about out there? And I also know that the money is completely gone currently. The 350 has been basically accounted for. So we'd love your feedback there.
I'll answer your questions, the last one first. And I'm not in any way taking a partisan position here. I'm just saying things as they are reported.
Yep.
The Senate came out and wanted to release additional funds into the PPP, and the Democrats stopped it because they wanted to add a lot of caveats to it, a lot of additional things. I don't know the details it asked for, but basically that it kind of got stopped up again. Now, why the Fed came in, right? It got stopped up a little bit over political matters. This Senate just wanted to get the money out. They went under the same rules, and the Democratic side, again, not taking a position here, just saying how it happened. I anticipate that that's going to eventually get done. The horse trading will commence, and that will get done to get more into that program. You're correct. Wells Fargo, though, I want to one thing, and I'm not here to support them in any way. I don't have a relationship with them, but they had serious restrictions put on their lending because they got in so much trouble for their bad behavior. So the government actually capped them in the ways that other banks weren't capped. They released that for them today. They released that for them today, which will help. But in a situation when banks have this, and they're getting well compensated to these loans, by the way, the Treasury, the Fed made it very clear that they were going to be compensated for this. They all want to lend. All the banks want to lend to everybody because they're getting paid for every one of these loans by the government. So, obviously there's a financial incentive, not only for the loan officers, but also for the banks themselves. But what happens usually is like everything else, the top clients for many of these institutions get the attention because they can make the most revenue from these people. Expanding it, and also too, the larger banks were better prepared to get their systems in place because it was really quick. Basically, that they got the final instructions, like I think Thursday night.
Yeah, it was like less than 24 hours. Yeah, it was crazy.
And the smaller regional local bank where many business owners have their relationships, they don't have the capacity, don't have the technology, don't have the capability to ramp up that quickly. So what caused a lot of business owners out of desperation said, I'm going to go apply at Bank of America, I'm going to go apply at Wells Fargo, but they were, no relationship, low on the bottom. My big thing I want to stress to business owners, and many of my clients, it's one of my specialties, is having a relationship with your bank is key in times like this. Really having a relationship with your bank. I've seen a big difference on the clients of mine that have banking relationships. Very small businesses are gotten further ahead than people who are just like, hey, I'm here to apply for a loan. But now that's water under the bridge, right? Here we are at this point. But I wanted to add a little bit of kind of color to that. But definitely,
I appreciate that. It means a lot to hear from you.
I want to add one final thing that I would recommend for business owners. Have your financial documents in order and easy to access, get to, and understand. Because many businesses, I know some of the restaurants I talk with, they don't know where this stuff is. They don't even do it. They have a bookkeeper who's also buried and overwhelmed right now. Have it somewhere electronically. You can get to it easily, fill out the application, or if someone in your team do it for you. It's a weakness for many business owners is the financial side, which is exactly why they're successful at whatever they do.
Yeah, totally. Makes a lot of sense. And that's a great takeaway for this. I didn't think about that perspective. So thank you for that. Mm-hmm. Great. So maybe we can, and also, by the way, I love the photo on your back right side over here. You and one of my favorite people. I studied economics undergrad and grad school, and I love Alan Greenspan. Yeah. I know you've had some interactions with him at events and been a guest speaker with him. Tell me what you are excited about now in this marketplace. Also, like I know we're going to talk about what you think is going to happen, but why do you love what you do? Like, what is it? What's your passion around this? Because this is not easy for a lot of people, right? It's not easy telling someone, hey, you're down maybe 10, 15% in this investment, or, hey, we got to extend your employment a few more years in your career, all those kind of conversations. These are not easy conversations, and it takes a true leader to step up in these times. And I commend you for that. But why do you do it? What do you love about it?
Well, I will say on that end, we're financial planners first, and all of our clients are prepared for an event such as this because we don't know when they're coming. I can see as an economist if there's excess in the system and I prepare my clients for that. That's 2000, the .com, and that's 2008. You could see it coming well in advance. I can prepare my clients for a downturn in the economy because economic data starts to weaken. It means, well, time for the recession. That's one of the seasons. We have 4 of them. Recession is winter. We can prepare for that. The one-off shock events. 9/11 is a great example. However, we were already in a recession during that time. So we were already obviously prepared for that, not because we knew it was coming by any means. And then this current virus. It was clear in February that things were deteriorating just because of the virus. When you plan properly for clients, you have plans in place for that. As to date, no one has had to change their plan, their retirement, or anything. None of my clients anyway.
That's awesome.
We
That's
plan
great
this.
to hear.
It is not because I saw it coming. It is not because I'm psychic. It is simply because you always prepare for this, because there's certain things. And I want to give you an example. I have a lot of clients sending their kids to college in September. I would hate to tell them, oh, you know what? First month's tuition.
Yeah.
Up. So planning, and I don't want to toot my own horn here, because there are other financial planners. A true planner does not depend on their investments to make a client successful. I truly thrive in these environments because this is what I'm wired for. This is what I've done for 30 years now. This is what I'm wired for. And when you have this shock, first the protection, and then when you get to this time, it's where's the opportunity. And this is going to be very unique from the last recoveries, is that many companies will fail. Now, many will fail. They will either be acquired at a much lower share price, or they will not exist, or they will never recover, because there's so much fundamental shift within the economy. The strong companies are going to thrive coming out of this. You cannot throw the equivalent to date. We're headed towards almost $8 trillion in some form or another that can be pumped into the economy. And if you can see these, if you can see the M2 numbers, which is the savings numbers, you can see the loan numbers, business loan numbers. I think I was looking at the number earlier. That actually shot up before the SBA, before the stimulus. Business loans shot up 83%.
Wow.
Businesses having access to capital through loans or other sources. And I'm bringing this up because this money in the system is going to make a recovery pretty amazing. It's not going to be straight up. It's going to take time. I would gather that the S&P as a whole will take 12 to 18 months to recover, but that's if you just bought an index. There are companies there that are going to fly in short periods of time, and there are companies that are going to struggle. So know what you own this time more than ever. Don't buy a basket or a bucket or anything like that. Know what you own, because there's going to be a huge divergence and dispersion between the success and the failures coming out of this, because of the fact some muscles will atrophy longer than others. Quick example, we're going to go back to restaurants and bars a lot sooner than we're going to get on a cruise ship. It's the reality of it, right?
Yeah, I'm going to be waving from the shore at saying hi to them from about 500 feet away, you know.
Yeah, and I'm not saying myself personally, I've never been on a cruise ship in my life, but man, if I was thinking about it, this would be the time to go, right? Be dirt cheap.
Totally.
But there are, and an example I use, and I'll say this quickly, is if there's a favorite beach that families go to swim and everybody goes to swim, and there's a shark attack, and the lifeguards shut down the beach. Okay, even when the lifeguards release the restrictions and say it's safe to get back in the water, everyone doesn't jump back in the water. The brave, the surfers, the strong swimmers, they'll get in first, the confident people. The timid will be the last to get in. And it's going to be the same here too. So everyone's not going to jump back in the water. They're not going to jump back in the water because people's financial positions are different. My clients who are tech workers, no impact on their income, right? They get to work from home and don't have to sit in Silicon Valley traffic. It's beautiful, right? Just fine. My clients who have restaurants, whole different story, right? Very, very different. So I want to stress that this recovery will be uneven, and you have to really know what you own. And I'll touch a little bit upon the real estate side of things.
Yeah, please do. We'd love that.
All I can say on this matter is people are going to buy houses again, and it's going to come back as people feel confident fairly quickly. Because I'll tell you what people are really thinking about as they're sitting in their houses days on end, on end, on end. Is this really where I want to live?
Yeah.
Right? It does. And I'm telling you, this is the feedback I'm hearing from people. They're saying, you know, I've been thinking to move, retire, move to switch, and now I've really made a decision. There's something about being in your home for a long period of time that makes people think about that. As people feel comfortable enough financially, they will make these moves. In addition, the effect, and I want to say this as an economist, and with all I know the effect that this is having on people. Depending on how the government handles the, I don't remember what they call it, the mortgage and rent holiday.
Forgiveness, yeah, there's forbearance. Yeah,
forbearance. There you go. I wasn't using the right term. Now, basically what this says is you don't have to pay your mortgage for 3 months. You don't have to pay your rent for 3 months. As of now, it's 3 months, but you still have to pay it by the end of the year. I would argue that most people that can't pay their rent for the next 3 months or their mortgage are going to struggle to pay it by the end of the year.
absolutely.
And I have a feeling that there may be some two-pronged government support here. Number one, government support either to the lenders who are lending money, you know, basically saying, hey, we're going to make it even to the lender so the individual doesn't lose their home, or They're also going to look at ways of supporting small landlords, because I have clients who have rental properties. That's the retirement income. They're not like, they don't have 20 properties. They're not super landlords. They have, one, maybe two properties. That is how they pay for retirement. So to tell them they don't get paid, and they're kind. I mean, they want to help these people, but they have debt. So many of them
Absolutely.
have debt as well.
Absolutely.
So I can see another stimulus coming along in this real estate space to help support the lenders, the mortgage holders, lenders, as well as the landlords, not large landlords. There'll be, I'm sure, a lot of political optics to that one, and as well as the people who simply can't pay their rent or their mortgage during this time. And that may change things, because again, it's a potential that you'll have people wanting to sell investment property saying, I'm done. I know that's with some of my clients. They're saying, I'm done. This was a trigger. They were just getting tired of being landlord anyway, but this trigger. So that may add some inventory to the markets, but I don't think it'd be that meaningful.
I'd imagine like Airbnbs and higher end second homes and kind of the core things people really don't need are probably at risk of going away for these people, right? Like, I wouldn't feel comfortable sleeping on an Airbnb pillow from someone I didn't know yesterday if they were sick or not, or what the deal was. It's making the mindset shift a little bit around, maybe playing it safe and going to a hotel is a better thing to do than going to an Airbnb or whatever vacation rental you have. So we see that already happening. I'm getting a lot of inquiries about that too. Either how to take cash out of the thing, or just get me out, like you said.
I think that's actually a really good point. And in addition to that, and not to be too conspiracy theory like on this, but just as an example, what if at some point the government says, hey, you Airbnb people, you need to donate some of your time in your house to some of our healthcare workers, okay, or to, because they're isolating from family. You will need to, give it to people who are less fortunate to help us out. That is a possibility depending on the duration and the effects of this, right? Because I'm talking about the economy and the markets, but everybody's economy is different. There's the mass, national or global economy, but there's everyone's economy is personal, right? Everyone's economy is personal.
Absolutely. Can you tell me about the shapes? So I've heard of, I think there's 3 or 4 shapes I've heard of the recovery. Mm-hmm. The best case shape is the V, right? Where mm-hmm. things dramatically go down and dramatically go up in a very short period of time, right? Mm-hmm. You have the L, which is a new one that private equity guys are talking about, right? Where we drop down and stay at a relative level, or is that like a reverse plateau, I guess? I guess a bottom.
It's a plateau on the bottom. It's a valley.
Yeah, valley. And then the last one is, and I think the worst case scenario is the just kidding, which is the W, right? The W, where we have a dip, a recovery that people believe in, and then it dips back down again before it goes up. What do you believe, if we can get into that kind of the next segment of the conversation, what do you believe this recovery looks like? And I'd love your insight, because you are honestly one of the most influential people I look up to for knowledge and education and perspective. So,
well, I have to say we don't quite know.
W, what do you think? V.
Don't quite know yet. Don't quite know yet. The reason we don't quite know yet is because there's a lot of factors that will affect that. How much stimulus do we continue to get? Will they continue to put more stimulus out, more stimulus out, more stimulus out? Or are they going to pull back, wait for a while and whatnot? Also, do we have a major resurgence of the disease that overwhelms the hospitals? That's the other question that we don't know quite yet. So there's variations to do that. The planning in this is you have to balance out your needs. If I say balance out your needs between now and this time next year. Do you have enough cash on hand to get through if things don't recover? And if that's the case, you would do things very differently, very differently. If you are long-term perspective, anything you do now is going to be fine in a year or so, right? But all things will not recover at the same rate. That's the important thing to know. All things will not. So general economy, your personal economy, it depends. And it is unknown at this point.
I think we lost Jim.
I think we did too, but I'm going to keep talking if anybody else wants to listen. He's recording it.
Yeah, nice to meet you. I was eating, so I didn't want to have my picture. Everything you said, I think, is so beautiful, because and I, because it's you and me right now,
Yep.
I have clients who are financial planners just like you are, and I can tell you, you are absolutely the most eloquently spoken, direct, and positive person in this industry that I have seen. The guy financial planners that have been in it for 60 years or 50 years or 20 years in Palo Alto, they just see gloom and doom. Like they just
Oh,
like,
there we go. I'm back.
yeah.
Okay, we're
Sorry
having,
about
we're having
that.
a great conversation.
Yeah. No, I was
Excellent. Brandy's
telling her,
on the phone. Perfect. All right. Good.
I was just saying, she's, you're amazing. It really, where I was going with it, Jim, was like my own financial planner clients do not have her eloquence, her vision, or her data. They come from a place, I think the world's changing, and they think they thought they knew what was going on. And so man, your clients are very fortunate to have you, but I'll let Jim take over now.
Well, thank you. You made my day. Thank you.
So sorry, I got lost on the LVW, the YMCA,
Okay.
whatever it is. Sorry.
I'll just say it's unknown yet, and also everything's going to be a different curve, right? Some things will be V, some things will be U, some things will be W, and because a lot has to do with government stimulus, we don't know quite what's going to be what. The highest probability at this point is at least, again, I got my giant list of companies that are and it's growing because we're getting ready to move, right? Are going to likely be successful. You still are going to watch because something could change. I'm just going to make up a random example. A company A is doing really, really well. And then something comes out that whatever company A is doing, it could spread coronavirus. All right. So these are all, it's going to be that scary time where people are going to easily spooked. Or company B is doing well, but then it comes out that they weren't kind to their employees during this time. They did whatever they shouldn't do. So there's going to be these little, I call it residual shocks to this. Overall, I don't see it being an L. And the reason I don't see it being an L is the stimulus. And on the Fed's level, I'm going to keep the politicians out of it because I can't predict anything these people are going to do. They're not affected by most of this anyway, so they're scoring political points. But with the fact that what the Fed's doing and what they say they're willing to do makes me think we're not going to have that. If we have a W, I still think it's going to be a compressed W, economically, broad picture. A V or a U, because it depends on your duration on your chart, right? Are you going monthly? Are you going yearly?
Yeah, totally.
It's hard. So a U can be a V depending on your log scale at the bottom. It's hard to say. What I'm doing for my clients, and I don't want this to be construed as advice for anyone I don't know, because everything I do is customized and personalized. I
love that about you, by the way.
There's not one size. Everything is constructed personally. Which you can tell I'm passionate about this because it takes a lot of time to do, but it's better outcomes. Is if you don't need the money, and when I say don't need the money, you have ample resources to get yourself through the year, and maybe even for a year. I want to be really cautious, but at least this year. And then now is a great time to invest in anything, right? It really is, because everything got so hit. But I wouldn't tell people, it's one of those things, and I'm not saying this to toot my own horn. I'm saying this is not something that's going to be easy. It's not going to do it at home, buy whatever you want, because not everything will be successful. And some that will be successful will struggle later, right? When their form of stimulus runs out, how do they manage debt if the revenues are still low? This is a company by company recovery. And it's really important to know what you own. And again, I want to say a caution that, because what the S&P does and what individual companies do, the dispersion is going to be really, really wide going forward. And again, on the broad, on the economy, on the individual and social level, it's going to depend on what people are doing. There's a big split right now between the people that have lost their jobs or likely lose their jobs or are forced to close their businesses down. Their economy is very different than someone who still has a job, whether they're working from home or they're essential workers. So there's this is a split. This is bigger than that 99.1% split. There's a big split, and that split is going to determine the outcomes for people going forward.
Makes
so
sense.
I want to stop here and make sure I answer all your questions.
No, it's fantastic. Looking for questions. I have another one around, I guess, how can I say this? Around time horizons for people, right? So everyone has a different objective, right? We all have different time horizons for our goals. Is there one or two of those profiles that you're concerned about, or that you're focused in on making sure is okay? Are you, like you said earlier, you mentioned that everyone's kind of in the right allocation and plan. Are you concerned about like fixed income people that may not have the time to recover from their assets being depleted a little bit? Do you see financial products like reverse mortgages being good tools? Like, tell me more about some of the people that you're most concerned about, or age groups, I guess, or conditions.
That's a very good point. A lot of risk still exists in the fixed income slash, we'll call it bond market, because I'm not knowing everybody's level of knowledge. There's tremendous risk there. There's going to be a lot of defaults. The government's not bailing everybody out. There's going to be a lot of defaults in corporate credit, especially a higher risk. So I have clients, new clients coming to me all the time, and they show me their existing portfolio and they go, I'm pretty safe. I'm all in bonds. And, it'll be some, I'm not going to pick on any companies here, but some large investment company, and they'll be in their bond funds and they think it's safe. But then I pull up the list of what they're invested in. It's like the lowest credit quality. It's garbage. And I mean, when I say garbage, it doesn't mean you shouldn't invest it, but you have to understand what you own. And the yields are high, and they're like, oh yeah, but I'm getting 6%, and it's in bonds, and they feel so excited. I'm like, well, no, there's leverage, there's risk, there's credit risk, and unlike stocks, you can really lose your money permanently in bonds. Bonds default, you don't get it back. Some hedge fund will come in and pay pennies on the dollar for it, and that's it. That's all you ever get. Whereas stocks, for the most part, you can ride it out if you have a long time horizon. And so there's a lot of conservative people that their money's at XYZ brokerage or XYZ investment firm, and they're all in the same stuff. It doesn't matter what their age. Amazing to see it. I can see 6 different portfolios from the same company, different ages, different risk tolerances, and they all have the same stuff in there. I'm like, no, this is not safe. And what's happened is these people realized it over this last drop when the bond market cratered. So these conservative people got hit. So I want to stress a lot. You really need to know what you own. Really need to understand what you own, and someone should be able to explain very specifically, even if you're not sophisticated. They have to be able to explain to you the risk of what you have to get that yield. They have to understand what it is. And I will say a lot of financial professionals don't really know because they don't build it. They don't really know. They do, their company says this, that's what they put their clients in. They're a relationship manager. They don't construct the portfolios. And so they understand, they trust their company. And their company it has their, and I don't want to, again, pick on anybody because I don't want to say it's right or wrong.
Right.
That's where I see the biggest risk that people don't understand. And it's been fine the last 10 years because the defaults have been very low, very low. And now, though, the results of, again, the muscle atrophying as the economy shut down is there will be defaults, and there will be companies that may default over the next year or so, because as the money runs out, the problem starts. So you can think of some companies that may take longer to see the revenues come up, but they have this huge debt load and the government stimulus runs out. The government's not going to give them any more money because the economy is growing. There you go.
Yeah,
there's
good point.
So those,
good point.
I honestly have more concern about the moderate and the conservative investors, not my clients, of course, but outside, because they don't fully understand the risk of it. So,
cool.
Sorry, I can get really into it. So let me stop.
Yeah, no, I love it. I love it. We have an expression, know before you owe, right? So that's a big thing for our side, is know before you owe. Like, know that forbearance probably isn't a good thing to do.
Yeah.
If you're not going to have a job, know that a loan modification or an interest deferment might be better. And each one of these lenders will have a different approach because of the different risks they have associated with each individual loan. So we don't see a blanket policy really going into effect with everyone. And I think the government made a mistake not having someone qualify for this hardship, because my neighbor might have a hardship, but I'm going to get the same exact treatment without a hardship. And that's not fair, I think, to a lot of people that are in those hard positions, because then they just get pushed down the road a little bit. And, I've seen a lot of delays right now, and the support and help going out there, people not being able to get phone calls returned. And it's also eye-opening to see that, I think they did a study this last weekend where about 40% of people don't even have enough saved up to make their housing payment for a couple months. And that was just like, that was shocking to see large restaurant chains. I won't mention names, but like there was one locally here in the Bay Area that just said, oh, we've been closed for 2 months. Or 2 weeks. We can't make our payment in April. Yeah. And that kind of started the trend of all these people just bailing on commitments they've made. And that moral hazard aspect of it all is coming into play now too, which was similar in 08, 09, and 10 with the strategic defaults. So.
Yeah, I can imagine. And I can imagine when people don't get the money that they're hoping to get, it's also going to facilitate a lot of people that thought they were going to be able to hold on and not going to be able to. Those are very, very important points. And I'm sure you're seeing a lot of it too in your space with people who are cash negative in this environment, didn't have enough savings and now need to borrow from their homes. Are you seeing that in your world?
We are seeing that now. And unfortunately, when you need the money, it's normally not available. So we're trying our best to get everyone positioned now. Every transaction I have has a line of credit behind it.
Wise thinking.
I just did my own refinance. I did a cash out, taking out money as much as I could, just so that I have it liquid for opportunities in my case, or just peace of mind. So I think people need to play it safe. They need to leverage credit appropriately, but also make sure they're protecting themselves, because credit cards will start getting ratcheted back. Certain lenders will start ratcheting back some of their guidelines and loan amounts they're willing to do. So in that environment, we just need to shift. We need to make sure we're ahead of that curve and make sure we're proactive to help people. So
Yes.
That's where we are on that.
Yes.
Well, I really appreciate your time. I know your time is like more valuable than anyone's time right now, and I really appreciate, Kristina, all you do for people. I've been a guest speaker with you at one of your events, and I was really proud to be part of that. And I just commend you for leading the way right now. A lot of people out there are hiding behind their desk or hiding behind their phone or not being available and present. And I appreciate you being a leader. It goes a long way. It says a lot about who you are and your character. And these are the times when it galvanizes people's reputations of being heroes. And I appreciate that. And we would love to know how people can get a hold of you and your team. So if you could please let me know the information, and I'll put it in the chat box. We have that available. What's your best phone number or email address that we can have people reach out to, or your website? Let me know.
Okay, I will give you the website and the email.
Okay.
The website is www.sequoiawa.com.
Yep.
My email is kkuprina
Yep.
at sequoiawa.com.
This is very rare, by the way, to have someone give out their personal information. So
No, I'll tell you why when I close this.
And it's SQUOIAWA, right?
You got it. You got it.
Sorry, I'm not good at spelling. I'm only good at numbers. Okay. All right.
And I will give the main office number, but
That's
know
perfect.
that because everybody's working from home, we get a immediate voice message when anyone calls it. Our main office is in San Jose. For those of you in Santa Cruz area, we also have office in Aptos. That's where I am right now, in the Aptos office. But the main phone number is 408-645-2500. Again, leave a message. We get a message, call you right away. Something I would like to say is, as you're sending this out, Jim, is this virus and the effects of this virus with the government shutting down and restricting things and whatnot has affected us in three major ways. It's not a one thing, it's a three thing. It's affected us health-wise, it's affected us socially, and it's affected us financially as a society all over the world. I have the capability to help people in one of those areas. I don't have the capability to go to the hospital and save lives. I don't have the capability to help people struggling with mental health issues during these times, but I do have the capability to help people with financial questions, be it challenges, questions, uncertainty, anything. And I am committed to helping everyone I can during this time. I will talk to anyone that reaches out to me. You do not have to hire me to become a client. My ability to do that is limited by regulations if you're not a client, but I will still get you in the right direction. That is my commitment to anyone out there. And for your realtors that are out there, if they're talking to people that are in the process, they're communicating with their clients or potential clients, financial planning fits very well around real estate transactions. Financial planning fits very well around mortgage refinancing or mortgage decisions. It all fits together. It's not in isolation. So perhaps something to do in a time when people might be, holding off and waiting is to offer to them, let's see how this fits in your overall financial plan. What type of mortgage is best? And Jim, I know you're excellent at doing that. For the realtors out there, real estate is a major life event. for just about everybody except the professional flippers or investors. It's a major, major life event. It often ties around a major life event, a death, a divorce, a growing family, a company move, something happening. That has a lot of financial pieces above and beyond the transaction. And oftentimes they'll have questions. Am I making the right choice? How is this going to affect my retirement? Should I get this or this? You can reach out to me. You can keep your client's information confidential. Say, hey, I got a client. They're doing this question. It's an estate planning question. Wondered if I could pick your brain. I'm more than happy to do the best I can to answer the question, because all of this ties in. So that might be a great way for people who are wanting to get information out to the people they're working with, even if people aren't moving on transactions right away. Might be a great way of helping people above and beyond what you do every day. I'm committed to helping people during this time. We are an essential business. We are open, as you can tell. And so far I've had the capacity to help everyone that's asked. So I wanted to add that as a commitment, whether it's your own self personally. Oh, final thing I'll say, I also will look at portfolios. If people have a question, hey, what do I own? I will look at that as well. Again, I've been doing this for a long time. I'm trained in experience. You still don't have to hire me, but I'll point you in the right direction. That's my commitment during this time, because that's the one thing I can do to help my community that I'm qualified to do. So
thank you for being a leader. We are so thankful for your time. Thankful for your time today. And I'm thankful to have you as a friend and a cohort and a peer and a mentor and all those things. And I appreciate your trust with everyone that you've guided my way also. So thank you again for your time. And I can't wait to have an event in person again soon. And definitely we'll be keeping in touch with all the latest developments of what's going on. And again, thank you for your time. And we look forward to talking to you again soon.
And I want to thank you for all of the great work that you do for my clients and the other people that I've sent your way. You're a planner. You're a strategist. You're like me. We share the brain. It's a real pleasure to speak with you.
Thank you so much, Kristina. Have a great night, and we'll see you guys soon.
Okay. All right. Bye.
Bye-bye.
Bye.